the feedback form that is shared at the end of this session. So from there, I would like to request Mr. Farooq Sabswari, the CEO and MD of Pakistan Stock Exchange, to please give his welcome address. Over to you.
Thank you very much, Sarwat. Thank you, esteemed speakers, Ehsan Malik Saab, Ahmed Jahangir Saab, Saqib Shirani Saab. Thank you so much, Mohammad Asim, for helping us put this together. It's clearly a very topical sort of subject. Everybody's talking about impact globally and on Pakistan. I just thought I'd very quickly rattle off what markets have been doing as a precursor on the discussion. I know a lot of people ask the very valid question on what the impact on Pakistan is, and why Pakistan, for example, a week ago was at a lower circuit on one of the worst days of this trade tariff war before a bit of a resigned inactivity. So markets have recovered, most of them. US is still down about 7% so that's still struggling. But this is 42 or 43% of global growth that is at a sort of tariff war situation, which is the US and China. Thankfully, the impact on Pakistan should be limited, but I'd like the panel to deliberate on that really. So hence we pulled in Saqib Shirani Saab as well to add to the macro bit. I mean, on its own, the Pakistan investment story, I think, is just getting better every day. You've got that Fitch upgrade now in the balance, and finally some talk of privatization moving forward as well. So clearly the good news continues, and then obviously remittances, a record number. So all of that compiled in, I think the question then becomes, there is clearly collateral damage when 42 or 43% of the world's GDP is in a trade war situation. What are the prospects of global recession, etc., and the impact on Pakistan? I tried to put this August panel together and have them discuss this in front of people who actually manage money in Pakistan or abroad as well. So thank you again, CFA Society. Thank you again, Ehsan Saab, for agreeing to do this. I was part of the PBC talk, which was a week ago, and that is what gave me the idea. So Ehsan Saab presented this trade tariff war outlook for Pakistan. And because the PBC houses some large players on the export side, textile and elsewhere, so systems is there too, the idea came up that we'd involve him and we'd involve Saqib Shirani Saab and maybe have one exporter also join the discussion. So thank you, Jahangir Saab. Over to you, CFA Society. Oh, in fact, sorry, Ehsan Saab, over to you to start the proceedings.
Okay, so thank you very much, Farooq. And I want to also start by thanking CFA and PSX for hosting us today. We are actually at a very critical juncture, but I'll go head on into the presentation, and then we can start. Okay, so very quickly, very brief. I hope you can see the presentation. Is that right? You can see the presentation?
Yes.
Yeah. Okay, great. Yeah. Okay. So I'm assuming everybody can too. But PBC, very briefly, is a business advocacy body. We are non-sectoral in the sense that we don't espouse the cause of a particular sector or a particular member. We try to speak for what is good for Pakistan and therefore live up truly to the first word of our name. And we're very fortunate that we have some of the largest exporters amongst us. So 40% of the country's annual exports are generated by our members. If you look at the top 10 exporters, generally 5 or 6 of them belong to the PBC. Besides that, the PBC membership also contributes a third of the direct taxes. They employ about 3 million people. And if you were to aggregate their turnover, that would represent every 6th rupee of Pakistan GDP. So significant economic footprint. As a result of the objective advocacy that we do carry a lot of standing with the government of Pakistan. So therefore, whenever there are crises such as this, they ask us to contribute. So we were very fortunate that so we're very fortunate that in the Prime Minister's group on US tariffs, we were invited. So our chairperson and myself, as representing PBC, but also we had 3 other PBC members. So Gul Ahmed, represented through Mr. Bashir Muhammad, Interloop, Mr. Musaddiq Zulkarnain, and Surti through Mr. Shahid Surti. So we were able to contribute for what it's worth. And I will share some of that contribution, but more to the point, set a context of how important the United States is for us in particular, and what might be the consequences and how to go forward. So first of all, I think all of us will recognize, and we've seen enough material on social media and other media, which would suggest that there are significant conceptual flaws with tariffs. So tariffs undermine trade because they invite retaliation. I put a tariff on you, you'll put a tariff on me. They also dilute the comparative advantage. The whole concept of global trade, or any trade for that matter, is that you focus on where you have a comparative advantage instead of wasting your resources on a very broad spectrum of goods or services. You focus on what is good and you buy what is more efficiently produced somewhere else. So what tariffs do is they sub-optimize the resource allocation. They also end up, in general, undermining the consumer value. So you produce goods suboptimally, and then you ask your domestic market to buy those goods, which obviously does not serve the purpose of giving value to your consumer, whether it is in terms of cost or quality. It may, in the short run, lead to some additional jobs. So, for example, in Trump 1, when steel industry in steel sector in the United States was provided protection, that led to a gain of 1,000 jobs in the steel sector. However, it also led to a loss of 10,000 jobs to all the users of that steel, because they were then made to buy an expensive steel produced in the United States. So yes, you gain on one hand, but you lose on the other. The other thing is that United States, actually, the last that it experienced a trade surplus was 55 years ago. And there are now echoes of the Smoot-Hawley Tariff Act. We'll go into a little bit about that in a while. And fortunately, the 90-day deferral that has come through is giving some time to negotiate, but also it also is a reflection of the importance of how the markets behave. So both the bond market and the equity market both slip in significant ways, which is very rare. And I think people in CFA would, who belong to CFO would appreciate that even more than myself. So it's very rare that both the sectors slip at the same time. Okay, so already anticipating this, there was a downturn in global trade. So overall, the container traffic, the bookings had started slipping from the last week of March. They were down about 50%. Overall, US import, the containers booked for importing goods into the USA were down 64%. The containers booked for exports out of USA were down 30%. Obviously, the imports from China were going to be impacted greater, so that was 64%. And also exports to China were down by 36%. This is the booking of the containers. So the shipping industry was already understanding the need to curtail they were suffering from loss of business already. I think a quick reminder that tariffs are merely a tool. So the objective that the United States has is not just to reduce or increase the tariffs or use the tariffs to induce a certain positive outcome. It is actually to do more trade. Yeah, I will remind you again of why I say that in a little while. Because the first thing that we think of is that tariffs, if we were to reduce tariffs, we will be able to please United States. That's not necessarily so. Okay, I think just to put US trade deficit into perspective, in 2024, overall $1 trillion tariff, $1 trillion trade deficit. That's split into 1.3 trillion goods deficit, and the balance is the services surplus. So there are many declining sectors. So manufacturing, coal mining, apparel, leather manufacturing, all those sectors that are listed on the left-hand side have been declining, over the years. And on the right-hand side, you've got the growing sectors which are not in the primarily in the manufacturing sector, not in the goods sector. They are more in the services sector. So software, healthcare, and so on and so forth. So this is how the United States has ended up with the kind of trade deficit that it has today. There are a whole number of US companies that have now outshored their manufacturing, not just because it is cheaper to do so, but because the United States does not have the skills that are required to produce. So Apple, the CEO of Apple is on record as saying that the reason why they produce in China in particular is not because it's cheaper. They are super efficient and they are focused. And there's one particular region, Schengen, where all of it is focused. So, the supply chain is very integrated, it's very close, it's clusterized. And the same packer or the same toll manufacturer also works in India for Apple, but also in Brazil. Dell does the same, HP does the same, General Electric is producing its turbines, etc., in China, India, and several other European sites, as well as, of course, in the USA. And I can think of many others, and I'm sure you can think of many others. So Nike, for example, produces 40% of his shoes in Vietnam. So there are very good reasons, and they're not just the low cost. Now, there's a school of thought in Pakistan. They say, well, if you're buying US goods, does it matter where they're produced? We are still ultimately, the profit of this accrues to a US company, but that's actually not how trade deficits or trade is measured. And we know that we've heard of President Trump trying to induce Apple and others to come onshore and start manufacturing. Okay, if you go back to 2000 and the top part of this map, you see a lot of blue, and that is when the United States was the major trading partner of almost the entire world, barring a few countries. So certainly for Pakistan, it was the largest trading partner. When I say largest trading partner, that's the sum of exports and imports, so bilateral trade. But fast forward to 2024, you see a lot of red. And this is now China as the factory of the world dominating and displacing the blue part, which is the US part, to some parts of Europe, some parts of Central America, and so on. So this is a phenomena that is happening worldwide. Okay, how important is the United States? Can it be ignored? The short answer is it can't. So 26% of the world's GDP, which is $27.7 trillion, is United States GDP. Consumption in the United States is 70% of the GDP, right? So $19.4 trillion are being spent every year on consumption. The equivalent in EU is only 51%. I know that the equivalent in Pakistan is more like 90%, but we are focusing right now on the export destinations. It also has the third largest population in the world, so 335 million people. And of that, 20% or 67 million people earn more than $100,000 per annum. So they have a lot of spending power. And the next very important figure is the size of the middle class. Incidentally, I should have mentioned that before I took on this responsibility of leading PVC, I spent about 24 years in a consumer product company called Unilever, and we know how important middle classes are. Because when you make soap and soup and so on and so forth and shampoos, etc., it is the middle class that actually is your primary customer. So here again, the middle class is very important. The size of the middle class is seemingly important. Okay, how dependent is China on United States? Extremely dependent. Yeah. So out of the 339 billion total that it exports, 96 billion is consumer electronics into USA. So 22% of its exports are consumer electronics. But the bit that is bit that is circled is textiles and clothing. So 17%, and that's 68 billion. Now, this is all types of textiles, not necessarily only the textiles that we export, but this is a very broad spectrum. And you'll see in a little while that China has a significantly broader spectrum of textiles that they sell into the United States than we do. Yeah? So, USA is very important to all of us, China and of course, Pakistan too. But if you look at textiles, there were in the early 1990s, almost 1 million people engaged in apparel manufacturing. there are only 84,000 people left in apparel manufacturing. So they have actually got out of that. And these 84,000, you may wonder, what do? They are primarily, I mean, not exclusively, but primarily stitching military clothes, because that is a requirement. So a supplier to the military of anything has to be, ideally in the USA. So most of these 84,000 people are trying to do that. Okay, so what are the general considerations then for Pakistan? I think the first observation is that Pakistan should neither ignore nor act in haste to import at any cost. There was an early feeling when we first started this conversation about a week or so ago that Pakistan should hurry to Washington and offer everything that it can. But, if anybody, I mean, everybody has negotiated something or the other in life, and we all know that if you, open up your cards, then you generally end up losing. So I think the government of Pakistan heard us right, and they said, okay, we will do our homework, but we will not rush there. So the whole idea now, the spring meetings are happening next week. So the finance minister is going to be there, and he will start the engagement, but the commerce minister, etc., would join. So the whole idea is to first understand what is exactly expected of us. Do they expect us, for example, to address the 3.3 billion tariff, 3.3 billion trade deficit that they're encountering with Pakistan? Is it even important to them? Do they want a little bit of movement? Do they want a significant movement? So they will understand that first. And in the meantime, have a whole arsenal ready of what can be offered. And we will share some of that possible arsenal. Then the other thing is that there was also a desire amongst our exporters in particular to say, well, the USA is so important that we should just basically make on a lot of things that they're interested in selling to us, bring it down to zero tariff. Now, under WTO rules, now, well, you could question, why is WTO rules even applicable, or why are they even important for a country like Pakistan? Because they're not important. The USA does not pay any regard to them. And maybe China can afford to ignore them too, although they're not currently ignoring. But a country like Pakistan, which is subject to multilateral support, and subject to a lot of outside support, cannot ignore WTO. So under WTO rules, you cannot unilaterally go and reduce the rates for one country without doing it for all the countries of the world. You can only do that if you have a trade agreement, and negotiating or starting a trade agreement negotiation at this point in time is not on, because USA is already engaged in trade talks with other countries. It generally takes 2 years to do a trade agreement, and so they will not be able to do that. But coming back to reduction on tariffs, when we do that, even if we could ignore the WTO rules and go ahead and do it for US, then we will end up offending our long-term partners who we are very dependent on for our financing, so China and Middle East. Now, having said that, the USA is also pointing to significant non-tariff barriers, and they're trying to create a level playing field for their businesses. But those are also the kind of improvements in the business environment that everybody, including PVC, has been seeking. And we'll come back and look at some of those. And then China aside, tariffs on most countries are unlikely to stay at these levels. So again, the point I'm trying to make is that we should not act in haste, and we should take a little bit of time, and we should understand what is required of us. Okay, so how important is the United States for us? Well, short answer is very important for our exports. So it is the single largest export destination, $5.5 billion we did in calendar 2024. So 17% of our total exports went to the United States of America. So obviously, very, very important. We are less relevant to the United States. So again, that is something that we must factor in. So Pakistan's exports to the US as a percentage of US's imports is only 0.16%. We don't even rank, yeah? And Pakistan's imports from the US as percentage of its exports is 0.1%. And we are 33rd in the order of deficits. And I'll just share how that works out. So I know that perhaps you can't read all these figures, but if I was to just say that, the top 10 countries that have a trade surplus with them, if you add up the trade surplus, or you add up the trade deficit that USA has with the top 10 countries, that accounts for 80% of the total trade deficit that the USA has. So Pakistan is way down, the circle bit, we are 33rd. Yeah. So we are not likely to be in the limelight in terms of the focus and the priority for them to be seeking significant latitude from us. But we still need to be cautious. Okay, there's a concept called a weighted average tariff. So this is based on what we export or what we import, and what is the tariff that we subject their exports to us, and what is the tariff that they subject to our exports to them. So if you take the weighted average of what we are subjecting to US imports is 7.3%. And if you take the weighted average of what United States is subjecting our exports to them, is 9.9%. So already on a weighted average basis, we are actually offering them a better deal. Now, one of the reasons why we are offering them a better deal is that a third of our total imports in 2024 were cotton, US cotton, and US cotton or any cotton can come into Pakistan at 0% duty. So therefore that, in terms of weighted, reduce the weighted average. So we're already, in terms of weighted average, very, very favorable in terms of supporting imports from USA. So let's move on to our exports, because that's, I think, of uppermost in most people's mind. I think the first thing, before we even look at that, is to look at, and I'm focusing only on a segment which is the major part of our textile exports, which is if those of us who are familiar with HS lines, 60 and 62, 63, 60, 61, 62, 63. Yeah. And this is the bulk of our exports. So we do 3.7 billion, as you can see in the shaded part, on the graph. So how does that compare with China, Vietnam, etc.? So China exports a total of 26.6 billion, so 7 times what we do. Vietnam does 4 billion versus, does 14.8. So on a multiple, that's 4 times us. India does 7.7, and Bangladesh is very close to that, 7.5 billion. So that's a multiple of 2. And Indonesia does 4.4. That's about 20% higher than us. So whatever we're doing, we are being beaten by, and significantly by, many countries. So that's, I think, first thing to bear in mind. I think the next thing that we need to look at is, how do we do in EU? So that was USA. How do we do in EU? Now, EU, remember, gives us for these HS, and here I've added leather also and footwear. We are able to export at 0% into EU. China pays 10.5% for these goods on average. India pays 8.3%. They're not entitled to GSP plus. So we did last year about $6 billion worth of exports. China, despite the fact that they were subject to duty of 10.5%, did 39 billion. So that's 6.5 times us. India, subject to 8.3% duty, did a bit more than us, 6.74. But look at Bangladesh. They were also subject to 0% duty, but they did 20 billion. Yeah. So 3 times us. Yeah. So there is something amiss in our portfolio of goods that we are exporting. Okay, let's go back to United States. The other observation that we have in our exports to the USA is that the average price at which we do the HS 60 to 63 exports is only 15,542. And how does that compare with the others? So Indonesia's average is 31, so twice us. So if you look at the multiple figure that I'm pointing to, Bangladesh is a little bit more than about 30% more than us. India's is about 80% higher than us. Vietnam's is again 80% higher than us, and China is about 20% higher than us. So despite the fact that we have the lowest price amongst at least the countries, in fact all the countries that are listed here, we are only able to do 3.7. So there is something that they are significantly better than us. Okay, then we now have the uniform levy, which is in the case of China 20%. In all the other countries, including Pakistan, is 10%. Then we have reciprocal levy, which in the case of China is 105% to bring the total to 125%. So their cumulative duty now comes to 156%, which raises the landed cost from 18.4 to 47.1. Yeah. Ours goes up from 15.5 to 23.3. Yeah. So the landed cost multiple now is 2 to 1 for between China to Pakistan. So they are twice us. Previously, they were only 20% higher. So we definitely, in this shaded bit, I'm saying we do have a significant advantage, or we will have a significant advantage over China. But in all the other countries, Vietnam, India, Bangladesh, and Indonesia, based on whatever is the reciprocal levy, we hardly have any significant movement. Yeah. So Vietnam becomes a bit more expensive than us. Bangladesh and in India actually doesn't become significantly more expensive than what they were previously. So again, there will be very little scope for us to eat into Vietnam, India, and Bangladesh's shares. But yes, the China share would be on offer. But remember, China was not winning on the basis of pricing alone. It was winning on the basis of quality and portfolio. Okay, so I think I'm not going to go to the top, 4 or 5 bullet points because those points have been made. I just want you to focus on the bit that is in red. And there, what we're saying is that the higher landed costs from all countries will depress demand in the USA, obviously. There have been various estimations on what the average household impact would be of the higher tariffs. I've seen figures, from 1,000 to 3,800 per annum for the household. So there's bound to be some, switching into cheaper goods, and that is where we would probably gain. Yeah. So I think that's maybe something that we can hope for. So let's move on to imports. So what do we import, and where can we possibly help USA? Again, I remind you the tariffs are only a tool. The real objective of USA is to reduce the trade deficit. Okay. So just a quick reminder again on the rules for change of import tariffs. I said earlier, under WTO rules, no variation is possible for a single country. It has to apply to all the countries. If we reduce the tariff for USA, we'll have to do it across the board. Only if there's a bilateral agreement, like we do with China, an FTA, then we can do that. USA is unlikely to consider any trade agreements at this point in time. We can use non-tariff preference, but then again, we need to exercise commercial sense in doing it. So at any cost would be debatable. But if you can reduce imports from one country and add to the to imports from USA, then that may work. And last but not the least, even if we reduce the USA with the tariffs on USA goods down to what we charge China, which under the FTA for many goods we charge 0%, that does not necessarily mean that USA they'll become more competitive than they were previously. But against China, it does not necessarily mean that they will become more competitive. Okay, so considerations for reduction in tariffs. Yeah. So obviously, commercial and technical considerations should obviously apply. The priority should be to replace sourcing instead of adding to higher imports in aggregate. The impact on trade relations with other current partners has to be taken into account. And again, sourcing at any cost is not desirable. Okay, USA is also seeking certain other things, right? So first of all, they want a heightened focus on agricultural items. So cotton, we are buying already. We can buy more. Soybeans, they want us to buy. Previously, for 2 years, we did not buy their soybeans because there was a GM issue that has been resolved. So we can buy now more soybeans. They want us to buy the frozen meat. There was a foot and mouth disease issue that has been resolved. Highly unlikely that this will become competitive, but to offer it to them, I don't think carries much of a risk. Dairy products, again, debatable. They want us to buy wheat when we need it. I guess they can bid for that. They're very fond of selling almonds to us in particular, but nuts in general. They want us to buy more corn. There could be some consequences on our agriculture sector. We need to bear that in mind. They also want us to buy more pharmaceuticals. But then they've also realized that USA does not produce many pharmaceuticals. They are also importing pharmaceuticals. But as and when they move their production of pharmaceuticals back into USA, they would like us to buy more pharmaceuticals and medical devices. They want, and I think this is led by Elon Musk, they want us to buy the EVs. Okay, so we could consider that. And of course, they want us to buy more machinery and iron and scrap iron, which I think again we can do. But on the ones that are circled here or bracketed here, these are good for business internal. They want the onerous inspection processes to be removed and to have an the unfair the level playing field on valuations, etc., to be removed. They want level playing field with the informal sector. I think all of us would like that. They want effective intellectual property rights. Of course, we do want that too. They want lower taxes. I don't think there's anybody on this call that doesn't want lower taxes. And of course, they also want to access public procurement. And there are certain limitations on certain goods when the tenders are floated that they need to be bought from Pakistani manufacturers. They're saying, well, why this? Of course, for military uniforms, they don't want us to bid for those. Okay, so I just took the leading multinational companies and compared that with Pakistani companies. So intellectual property rights, all of them are affected. I mean, all the FMCGs are affected, and so are the FMCGs in Pakistan. The level playing field with the informal sector, I think all the FMCGs are affected, and so are the Pakistani companies. The regulatory drag or the ease of doing business, all of us would love to have easier ways of doing business and lower cost of doing business. All of us believe that we are subjected to higher taxes. The foreign multinationals obviously have remittance issues. The sales ethics in the medical field obviously impacts the probably one of the only pharmaceutical MNCs left, which is Abbott Laboratories. Price controls again affect the pharmaceutical sector, so they would like to have more liberal domain on that. And Chubb, I think, is affected by the fact that the underwriting is restricted to the National Insurance Corporation. So they would like to participate in underwriting also. So these are, I think, I think even the Pakistani businesses would want Pakistan, the government to move and liberalize and open up the economy and, of course, create a level playing field. Okay. Now, there are certain levers that Pakistan can use other than tariffs or non-tariff barriers. The first is obviously, as always, Pakistan, plays on its geopolitical, importance. And so there may be some regional security cooperation. USA is on record as saying they need to go back and recover all the armaments, etc., that they left. I don't know if Pakistan can play a role on that. We've had, helped them in capturing one of the people that they were looking for. That kind of cooperation obviously can be played. We could do some defense procurement. I think, we're always looking for augmenting our defense capability. And of course, everybody talking about minerals. And you would have seen that, there was significant presence from USA in the mineral conference that this happened. Of course, this is down the line. This will take about 4 or 5 years, but they want to get involved. IFC and their lending institutions are already willing to fund this. So I think participating in that, giving them hope, would be one of the levers that we could use. But then let's come back to what we can do for what we are importing currently. The yellow shaded bit are the major imports that we do. So it's about 70% of our total imports. The top import that we do is obviously petroleum. I mean, this is across from all parts of the world, not just USA. The third column is USA. So we, in 2024, imported $17.8 billion worth of petroleum, of which only 0.1 billion, so 100 million came from USA. And USA has the capacity, and they export 320 billion across the world. So they could potentially meet our entire, requirement. Not that I'm suggesting that we actually do that, and I'll tell you why later. And so on, right? So these are perforce the kind of things that we must focus on before we go on to the others. Okay, so the same chart now. We say that we start with petroleum. So I think all of us will be conscious of the fact that the freight from USA to Pakistan would be at an on cost versus the freight from the Gulf to Pakistan for oil or for gas. Yeah, there's an estimated, if we were only to up our imports by 0.5 billion, so 500 million. there would be an on cost of about $22 million or 6 billion rupees. Now, that's not a lot of money. But I think the government initially was very interested in pursuing this, but they have now, they're rethinking that, and they're saying if we can do something else, we would rather do that, and let's just find out how much they want us to do. So all these figures actually add up to 3.1 billion, so which is about approximately the trade gap right now. I think the major components are the ones that are high listed. So oilseeds is basically soybean. So soybean is imported into Pakistan basically primarily for animal feed. Yeah. The GM issue has been resolved for the USA. The other alternative source is Brazil, but the GM issue for Brazil, they haven't been able to give us certification, so Pakistan cannot import soybean from Brazil. So therefore, and in the meantime, China, which was a major buyer of soybean, is no longer buying. So the price has come down. So it's actually commercially feasible for us to buy more soybean from them anyway. So that's about $700 million that we could do from them. Cotton, we have a cotton deficiency. We didn't have enough cotton last year. In any case, if you make apparel based on US cotton, then the tariff on that particular item of apparel is lower than otherwise. So we anyway benefit. And again, as China has stopped buying cotton from USA, we would suddenly become the largest buyer anyway. We were the second largest previously. So we could quite easily buy another 600 million. Yeah. And the other bits are relatively small, 0.3 billion and so on and so forth. But you add it up. So we could potentially come very close to 3 billion, but I don't think the USA is looking for a 3 billion makeup. They would probably reconcile for half that to begin with. Yeah. Okay. So far, we looked at the impact of the tariffs, in the context of Pakistan and USA, or the world and the USA. But once China is displaced in the US market, they are not going to keep quiet. They have surplus capacity. They will deflect their exports to markets such as ourselves and to the other parts of the world, including Africa, developing markets, EU, and so on. So there will be a lot of friction that will now be created between China and the rest of the world. Yeah, this will be a fallout from the US tariffs. So Pakistan has an ambition to widen its geographic dispersion. That will come under pressure. The other major watch out is potential dumping. China is known to dump products across the world, including Pakistan. And Pakistan's anti-dumping regime is very weak in a number of ways. So for the longest time, until recently, the NTC was non-functional because the requisite number of commissioners was not there. The government had not appointed. Now they have. So it's become functional again. But imagine if for 6 months or a year, the NTB does not function, then there's no work done on anti-dumping. Yeah? The second point is that, and this is the global requirement, it takes 2 years of harm before an action can be taken. So for 2 years, you've got to suffer, right? So if China or anyone steps up dumping into Pakistan industry has to suffer that for 2 years, keep proving it to the NTC, and then the NTC will begin an investigation. But their resources are very limited. And whenever they've done investigation in the past, they have determined the harm, or they've determined the duty based on the harm that they were able to determine, which is significantly lower for the same item, where the anti-dumping duty in another country for the same item is 3 or 4 times what Pakistan is able to prove. Yeah. And last but not the least, the enforcement, the collection of the anti-dumping is very weak. People get stay orders in Pakistan. It's very easy to get a stay order. You move from one high court to the other. There are several high courts, and the recovery is done by the customs, and it does not, it does not count as part of customs revenue. So they actually have no great incentive to recover anyway. So this regime has to be significantly addressed. So what are the consequences? So I've split the consequence in terms of cash flow and potential loss of export. So the first bit is cash flow. So this is from delayed settlement by US buyers of up to 4 weeks beyond the current SPP deadlines. Yeah. So currently, because of the uncertainty, etc., people, customers in USA are saying don't ship, delay shipment, etc., etc. So if you take the total exports of 5.5 billion, and you take 4 out of 52 weeks, that's $425 million, and 120 billion rupees. So that is the kind of relaxation that the state bank would have to find a way of giving. It would also have to consider some kind of COVID-like temporary credit facility to carry the exporters. What the government has to do in the meantime is that the export facilitation scheme is under review, and very quickly what had happened was that before the last budget, the importers could import any items duty-free and sales tax-free, provided they use those items for export. And they could also buy the same items or similar items from the local market, again, free of sales tax. But under the last budget, the sales tax was levied, which then rendered and that sales tax actually is recoverable by the exporter, but it takes 18 months for the exporter to get it. So exporters have lost interest in buying from the local market. So this is why you hear about a lot of the weavers and spinners going out of business and Faisalabad being shut and so on and so forth. So the proposal now, various proposals have been considered. One is to, well, let's go back to charging everybody sales tax or come to some other settlement. But, you know, with the pressure that Pakistan's export sector is going to be in, we always saying, you know, don't do anything that would impact the cash flow of the exporters. The other thing is that as part of the last budget, in addition to a minimum tax of 1% on turnover, there was an advanced tax of 1% of turnover, which was levied, which again, for the medium-sized exporters is a real issue because most likely their profits do not justify that, and that's recoverable. But again, it takes 18 months to recover that, and that therefore saps the cash flow. So these are the considerations for which, you know, we would have to find a way to cover the exporters for the delayed shipments and delayed settlements. Sorry. Then loss of exports. So the buyers are obviously reluctant to commit orders at this point in time. So I've just taken 10% of exports for half a year. So that would amount to 225 million. And the US buyers are also demanding discounts. So they're saying, well, you know, half of it you pay, half of it we will pay and pass on to the customer. Now, a very conservative figure, I've just taken 5% of 5.5 billion, which amounts to 140 billion. Then the other issue is that when China becomes aggressive, particularly in the EU and the UK, there's likely to be some impact on Pakistan's exports there also. Between the two, we do about 11 billion there. And so, you know, if you take that, that's about 550. So if you add all that, that comes to about 1 billion. Now, what can be done? Of course, to avoid or to expedite or get rid of the uncertainty, we must engage the US government, the Trade Commission there. We must address the NTBs, etc., and look at the tariffs in whatever way we can. We must also look at the energy cost, because energy for exporters, for all of industry, is very expensive, way above the what the regional cost is. And we must also to preserve the EU, we must redouble, the government must redouble and comply with all the conventions, because the next review, when it comes up, will be a little bit more demanding. And of course, our exporters must also comply with the carbon, avoid the carbon border tax. The other thing, I think people in CFA would or belong to CFA would appreciate that for quite a long time now, we've had a near static exchange rate. In an ideal world, your exchange rate must keep adjusting with demand and supply. And of course, demand and supply is being managed with the State Bank of Pakistan buying and so on and so forth. In the past periods, in the Musharraf era, in Dar Saab's era, we had long periods of static exchange rate and then a steep correction. That is something we must avoid. When there is a steep reduction, steep devaluation, that upsets everybody. It removes the predictability. It is much better to do a gradual adjustment. And the business obviously needs to look at its portfolio, try to do some of what China and Bangladesh and India are doing, broaden the export basket, and look at the geographic dispersion, and of course add more value. Okay, now grow more, grow better, make more, make better, and serve better are the platforms under which Pakistan Business Council operates. But to export, we need to make and produce stuff which is exportable, which is competitive. Yeah. So there's a whole lot of things in the agriculture field where things like meat and horticulture we could potentially export at least, or at least import less of. In manufacturing, pharmaceuticals, I mean, 20% of Africa's entire pharmaceutical needs are met by India. We really stand nowhere at all, right? So pharmaceuticals have in collaboration with Chinese investor, we have the first Pakistan-China joint venture on manufacturing tires, which by the way is exporting to USA, which is a good move, but others can too, and light engineering would be other. And of course, in the services sector, IT, call centers, and of course, on the softer side, putting our dramas on Netflix, etc. That would help. Okay, but there are some things that business requires, and the whole list of things. I'll quickly run through it. We talked about the energy being competitive. We talked about equitable taxation. You can't keep taxing the same people that you've already taxed. The tax policy needs to be predictable, and the fiscal policy should be aligned with all the other policies. You can't have a standalone fiscal policy which is not aligned with your industrial policy. By the way, you should have an industrial policy to begin with. We don't have, but it also should be aligned with the trade policy. There must be a level playing field with the informal sector. Under-invoicing goes on, smuggling goes on. There's a 3 to 5 billion difference between what China says is export to Pakistan and what we recognize at the import value. So somebody is making money on that. Ease of doing business, it's exceedingly difficult to do business. There's a regulatory drag on business that needs to be addressed. Now, export incentives were, we need to do a comparative study with what Bangladesh offers. It's not just energy. There are lots of other things that they're offering. China does it. So does India. And we need to have a comparative, offering. We need to brand Pakistan. Land is not available. I mean, Karachi's all the industrial area land is so expensive that no new industry can be established there. And even if you did, you won't have the utilities. In Pakistan, there are no DFIs, so there's no long-term credit available. If today you go to State Bank of Pakistan and say, I'm going to set up a new industry, I need $100 million, you're not going to get it. You'll be in a queue. The exchange rate needs to be gradually adjusted. We talked about human capital and productivity is poor. Anti-dumping, we've talked about. And of course, infrastructure, especially in Karachi, is exceedingly poor, and we need efficient logistics. It costs a lot of money to move goods. If you compare Bangladesh as a competing country with Pakistan, Bangladesh is a compact country, and most of their export industry in Chittagong, which is very near the port. So they don't have to move the cotton or whatever they import in a long distance, and they don't have to, move the goods back to the port when they're ready for export. We have to take goods to Faisalabad, to Lahore, up country, then we have to move them down. And the logistic costs, doesn't help us. So there are some gaps in Pakistan's textile exports. So we do really well in the knitted bed linen, but we don't do well in printed bed linen. We do well in cotton ensemble, but we don't do well in wool and synthetic fiber suits or technical textiles or activewear. There are one or two exports. Interloop really does a great job in activewear, but that's an island in excellence. And the other thing is that in sweaters, for example, we do a good job on knitted articles, but we are very modest in cotton and synthetic fiber sweaters, to name a few. Then we also export a lot of cotton and a lot of yarn and a lot of fabric to Bangladesh. So in 2024, we did 594, just about $600 million of export of low value added items to Bangladesh. We could have added value. And if you work on a 2 to 3 multiple, that would have generated another 600 million to 1.2 billion worth of additional exports. So that's a missed opportunity. Then to broaden our geographic, or to widen our geographic, or to disperse our geographic reliance, we need to do several things. With USA, obviously, we need to manage the current crisis. In the long run, we need to look at, whether they could be amenable to a preferential trade agreement. I don't think a free trade agreement would even work to the advantage of Pakistan. With China, we need to renegotiate FTA. Now, it may come as a surprise to some that the headline figure, when you look at the FTA with China, says 45% of goods from Pakistan can enter China free of duty now. And by 2030, 75% of goods from Pakistan will be able to go to China duty-free. But if you take out the goods that we either don't manufacture or that China does not export, today we can only export 14% of our goods duty-free to China. And by 2030, using the same process, it will be only 24%. So these 45 and 75 figures are totally misleading. We need to go and renegotiate that. And to give you a parallel, Bangladesh, with no free trade agreement, but working on their geopolitical advantage, obviously relative to India, today can export 96% of what they make duty-free into Bangladesh. So there's a country within a region that is negotiated with, a country where we have very deep relationship, but to a better advantage. With EU, obviously, we need to maintain our GSP plus. We need to avoid carbon tax. With UK, the equivalent of GSP is DCTS. It's just another abbreviation, but it's the same as GSP plus. With Japan, Canada, and Australia, we need to see parity with Bangladesh. Bangladesh can get their goods in duty-free. Bangladesh is, by the way, not an LDC. They had that advantage when they got the LDC, when they had the LDC status. Now they don't have it. So, we ought to negotiate. Africa, Latin America, and Central Asia are new markets that we need to look at, and I'll look at Africa in a little while. Trade advisories is something that we need to work on, and of course, visas. And one of the dilemmas that we have is that most of the buyers in the textile industry in particular are Indian or Bengalis. Well, with Bangladesh, is now becoming easier for them to get visas, but for Indian nationals to come to Pakistan is still very, very difficult. Okay, Africa, I said. By the way, Africa, in terms of geographical landmass, is the combination of India, China, continental USA, and Europe all put together. So that is the total area mass of Africa. There are 54 countries in Africa. 1.5 billion people reside there. The population is growing almost at the level of Pakistan's growth rate. There'll be about 2.5 billion by 2050. It's young population. Half of them are under 20. The combined GDP of the entire continent is 2.2 trillion, which is 6.4 trillion in purchasing power parity terms. The annual imports are 714 billion. We exported 1.5 billion, which is 0.2% of their imports. India, on the other hand, did 42 billion, so many times us. India has more trade agreements and more in-country commercial representation than we do. So on the ground, they have more commercial counselors than we do. We, by the way, have one trade agreement with one country called Mauritius, which is, by the way, not in the main African continent, somewhere here. Yeah. And India also offers concessionary credit for machinery imports. So that is actually all that I wanted to say. So thank you very much for your patient listening. I hope this has been of some use. Maybe we can come back and discuss some of the other issues. So I'll stop sharing this.
Thank you so much, Ahsan Saab, for such an intense presentation. And in the interest of time, I would quickly request Mr. Ahmed Jahangir, who is the Executive Director at Nishat Mills, to please shed light on the topic.
So let me begin by saying, Ahsan Saab, what a magnificent presentation you've just made. It encompasses so many aspects. And whether we were discussing tariffs or not, this would be a very informative presentation for everybody. And it does bring us to another topic, which is not part of today's discussion, that a lot of the discussions that you talk about hover around in a bigger circle, where what in the textile business we say is that if only the government can get out of our way, we might actually start to walk in a straight line rather than the zigzag manner that our industry goes up. So this is something that we've been saying for a long time, but unfortunately doesn't change. So I do have a very, very short presentation. So this will be a different, difference from the previous one. So I don't want to get into the details and some of the, I would say, numbers or the backgrounds of what the numbers have already been shared, and most of you might have these numbers, but I do want to go to the history of how we got here, because to some of us who do textiles and apparel and home textile and towel business, a lot of this was long time coming. I mean, what we see today happening on the US side is just an acceleration of something that would have happened anyways if nothing would have been done in overtime. So if we could move to the first slide, and I can just give you a brief history. So I want to talk about basically how we got here, what's going on at the moment in terms of different opportunities that were quite detailed by Sansab as well. But I'll focus on some of the nuances, the materials, the raw materials that we do and we can do in terms of the near competition, because everybody is our competitor, but not everybody has the capacity or ability to produce what we do, and vice versa. We don't have the ability to produce products that might be an opportunity today because we don't have the supply chain at the moment. So if you look at the first slide, what is happening today, everybody trying to become bilateral and protectionist, has been going on for some time, but it all started from opening up this whole global economy in the 90s when, the quotas were taken away and everybody became a global vision and everybody started rolling. And these were the times when all nations decided what they wanted to do for the future and how would they position themselves. So Pakistan took a set of decisions, India took a set of decisions, other countries did as well. And so we are finding, and for a reasonable time, industrialization, use of cotton into value-added products, and textile specific, I will stick to it. Many other industries that could have been developed were neglected because after the nationalization part was rolling back, textile was the only major industry that was already intact, and the supply chain was also intact. And because we had an unfair advantage of a cheaper raw material, and everything else was cheaper along the way as well. So this became something that we started investing in. However, the way it was designed, everything was invested in the raw material part of the business, which I call spinning and weaving. So you make the thread, make the fabric. And that was a big business that we did till the 90s, and slowly towards the mid 90s, value-added businesses came up. Some knitwear was there, and home textile was prevalent only in Karachi. So that part we enjoyed for a reasonably long time without any effort. We didn't really have any policy or motivation on the private sector to do anything more than what we did. So if you look at our mix, the raw material side within cotton was the primary business, what they did. We didn't do a lot of synthetic, we didn't do a lot of apparel. We really didn't do any other product related to the textile chain, except for the raw materials that were happily being sold to other countries, including the US, Europe. We had discovered the Turkish market. We helped them grow in those years as well. But then everything changed. The first thing people started talking about this interdependence was the financial crisis that happened in 2008. So if you look at it, it really spooked that one bank, Lehman Brothers, started something that could have actually resulted in a financial meltdown if people didn't, print, for lack of a better word, crazily and flood the market with foreign currency or hard currencies, and to keep that liquidity alive. So people started questioning the financial interdependence of larger countries. Pakistan was nowhere in the financial markets anyway, so we didn't really feel the pinch, one, and whatever we felt sort of got, I think the only thing was the stock market stopped for a few days, and that's it. So we didn't really get the difficulty that the world could have gotten in, and how we got back was also easy. So within a few years, I think most people forgot about it, but not the Western or the developed world. They started creating ways where their decoupling existed. There was a lot of checks and balances, a lot of financial institutions and money management mechanisms that were cropping up in the Asian side, Middle East, and everywhere else sort of got locked down, and everything went back to what we call the Western financial world. And to this day, we continue to have majority of this business there. And then nothing happened. Everything was normal. The business was open, and we continued to be quite open. And more businesses cropped up in Pakistan in textile, where value added became something that you wanted to do because we had a cheaper credit, and we were still not market based cotton, and so there was some level of ease that we were increasing the production of cotton, despite the fact that we had not come on the GMO seed bandwagon and everything else that was supposed to happen. And so middle of 2012 onwards, slowly it started to become clear that we are lagging behind in terms of productivity. But nobody talked about it in very open terms, that we were not only a lack of yield in cotton production, we actually were lagging behind in every single agricultural product that we used to make. And because we had pricing decisions, support prices, and the kind of crops we had also were not high value added, they were low value added, and you didn't really could make anything else. At the same time, as the world was moving towards more synthetic, we were still focusing on more cotton per se and natural fibers. So you'll be surprised that when 2015 to 2018 part, multiple times cotton policy was made. Every cotton policy said the same thing, that the world is 70% synthetic and we are 30% synthetic. So we need to go towards that. But then nothing really happened in terms of creating a backup or a supply chain of petrochemical industries that India did or Thailand did, and other people had it in China as well. So all of this was great. Nothing was happening. There were a couple of major financial crises happened with textile industry, but all in all, the companies were getting bigger. There were listings, export was increasing, but then we started losing our crop sizes every now and then. So 2020 is the COVID part where the world started discussing physical trade and supply chain interdependence, because suddenly even richer nations who had the money could not get access to products that they would want to safeguard their populations. And that's really what spooked everybody. So since then, I can say easily that things that were in half speed or sort of, by the way, they came in the forefront. So these are what I call the subtle barriers and protectionist mindset that came to almost every part of the world. The colleague before, Ehsan Malik Sahab, talked about China, that it's a misnomer that it's an open market and we can sell everything. Textile, it's very, very hard to sell textile in China, because the way what we produce and the way they want to buy it, even though they need it and they export all of that good quality product abroad, they will not allow it to come into their country because of the pricing and the supply chain mechanism that they have. You have to sell it to somebody local, and then maybe they will create a brand and do something. But so far, most of the companies who attempted it, it's been limited success, and that could have been a big market for Pakistan, but it still isn't. So if you look at it from Europe or southern, I would say northern Europe more so than southern Europe, and the US, all of these subtle ideas have been around for a much longer time than the 2022, 2025, or what's happening with the Trump 2.0 situation, where everything is sort of going to be readjusted. So climate accords you've talked about, the bigger countries don't really follow it. Everybody was using coal 40% and above. India, China, United States, a lot of European countries still used a lot of coal. They call it clean coal and all. So all of that, you couldn't challenge them. But the minute countries like Pakistan and some people here started using coal, we had our own problems. But I remember the first time coal started becoming a primary product that we use for steam and some electricity, I think almost every customer from Europe and America came and said, can't do that. You have to have a phase out of coal. So we were less than 2% usage of coal at that time in our energy mix before the big coal plants that we put up. And we were there, they were still talking about phase out. And we have agreements in place that, by 2030 and 2027, you have to get rid of it. And when you ask them, are you getting rid of all of these things that you have? So they're like, yes, we're going to close them down, but they're going to just shut the plants down. They don't dismantle them. So there's always that chance that when they need it, they come back. So it was always an unequal market in the world to begin with. So labor laws are the same. When we have kids working somewhere, obviously exploitation in the third world countries a lot more, but it's not like nobody works below 18 anywhere in the world, in the Western world. They call it, the students are working or that. And everybody believes that the labor laws safeguard them. Anybody who's lived in the Western world and worked as ice cream shop at age 13 to 18, 15 understands that there is a lot less protection than you think, even for those kids. So, but the point is, nobody can actually audit that. So I asked once my client that, you want to have a social audit in my company, which I've passed about for 10 years, but can I have a social audit of your office? And I'll pay the $5,000 that you need for that. Believe me, not a single person ever in America or UK or Europe has taken up my offer to have their head office socially audited on the same terms as our factories are. So it's a very surprising fact that most people don't talk about. But so all of these things have been happening. This is just a way to keep the control over who sells what to these markets. But as producing nations like India, China, and to a certain extent, Vietnam, Cambodia, Laos, and Turkey, Egypt, and Pakistan have become bigger and stronger and more knowledgeable about the trade laws of the world, we have pushed back and increased. So over time, our businesses have definitely increased. But these things have always remained there. So now, more recently, you must have heard about sustainability. the definition of this word keeps changing because the US doesn't want to do certain things with raw material that the Europeans want. So the Europeans have a different standard for sustainability and they follow the different rules. The claim laws are different. Similarly, about post-industrial recycling, which is easier. Post-consumer recycling, you must have heard from last 15 years. I think nobody does it. It's just something that we talk about. Theoretically, if you look at the costing of it, you have a higher carbon footprint to take a lot of textile products, which is very toxic in terms of its colors and dyes, and bring it back to white and then try to make it again. Then what you have to spend to grow your own crops and actually use it. So that's not really sustainable. That if you're spending more energy and freight to do something which is actually going to yield you a much lower value. And then more recently, water recycling. So, I'm completely on board with the water recycling, and that's how we should do it. And our countries do need better reservoirs. But I do ask a funny question to most people that bring us to these seminars, and I ask them, you keep giving us this lecture about conserving water. 75% of the water for the next 100 years is above India and Pakistan. So why should we conserve? You guys are the ones who should be conserving all the water. But they have no answer for that. But at the end of the day, they don't need to give an answer. They have standards. They have ability to enforce whatever they feel like, to whatever degree they feel like it. And they continue to enforce it because they're the buying nation. Net effect, everything has to be sold to them. And as their GDPs have grown over time, and they are the biggest beneficiaries of this open global marketplace that happened. So producing nations definitely have become bigger, but the consuming nations definitely have become much richer in terms of having better financial markets as well as control over what goes on in their territories, and then what goes on globally and the rules are made by them as well. So I say all of this just to give you a backdrop of that protectionism and some level of control the buying nations have always exercised. Mr. Trump has just come in and said, all of you thought we were equal, but we're not. So I'm, first among equals, and everybody else has to listen to me. So that's where everybody's angry, or at least unhappy about. But all major nations, to a certain extent, have done it. We do it to things we import also. If you ever imported something in Pakistan, you will realize that if somebody had to do it without knowing anybody in Pakistan, that would be an amazing feat, that if your product could get here without getting into trouble multiple times at the port and then during. I'll give you, close the slide with a figure that shocks most people. If you import coal from Indonesia, the freight to Karachi from Indonesia is maybe $17. The truck freight from Karachi to Lahore is $42. So how we are going to do any of this import for re-export and all of these globalization and benefit? These are our own systems that haven't balanced out. And so we have our own burden to bear. So let's move on. So this is the backdrop I want to create my presentation around, that this was going to happen regardless. And most of us, including some of the countries that are our competitors, have not really prepared for it. Some of them are more prepared than us. And if you look at Pakistan's discussion around energy cost, import, export, government getting out of the way, difficulties of regulatory processes. We talked about the same things when I was a young kid, maybe 35 years ago. The same conversation we've had almost every 10 years. It just changes in nature. And there's a lot of blame, the Pakistani private sector doesn't do this. Why don't you export more of this? Why don't you expand your process? Why don't you have more goods? Other people are selling so many different variations of textile. Why don't you do it? And the difficulty is that why don't you do it is answered by, because we can't afford to do it. And if we do it, it won't sell at the cost of production that we operate in and the size of industry that we have and the way everything keeps changing. We're talking about tariff discussion today. Even today, there is a gas charge that has gone up, and there is a retrospective gas amount that is being recovered, something that was announced in March, and now we have to pay it from January onwards. Everything I sold in January or February, I didn't even know about this extra cost that was going to come. So, it's easy to put a lot of blame in the private sector, but it's very hard to acknowledge that the contributions to some of the failings that Pakistan has had comes from a lot more than just the private sector. Anyways, moving on, Ehsan Saab has detailed this slide very well also, but I'll just mainly describe it as a lot of countries are our competitors. So we sell apparel, we sell home, bath. In the textile space, we sell a very narrow band. But if I dedicate it into the clothes that you wear on your body and the stuff that you use in your house, that amounts to about 92% of what we export in textiles. And the clothes that we wear on our body and is a much bigger. It's about 65% of what we sell. And the countries to the southeast of us, India, Bangladesh, Cambodia, Laos, Vietnam, and all the way to China, most of them have become the powerhouses of apparel manufacturing and export. And the home textile part, yes, India has some, but we have an advantage over India in terms of doing this for a much longer. But countries like Egypt, more so than, countries like Argentina, Brazil, but Turkey, being a very big part of this business, has also a very big industry like Pakistan. So they've got a massive advantage over us now. If you look at the new tariff regime that will come after 90 days, they're still at 10%. So Egypt at 10%, Turkey at 10%, excuse me. Some of the South Americans, other than Mexico, they're at 10%. So there are a lot of these things that are in, they will give a disadvantage to us. So all in all, moving on to the next slide, all it says is, I think we can skip this one. This was already well covered. The China exports, most of the stuff is electronic. All it says is that these countries give us an advantage in apparel. So we will have an unfair advantage because we sit at 29%, and most of the large suppliers of apparel to the United States sit at 37 to 49%. On the other side, the biggest competitors that we have, other than India, which is 26 and 29% for us, are at 10%. So the home and bath businesses may get a lot of challenges, but on the apparel side, the challenges might be in our favor, and we will actually be hoping to benefit from this. Can we do that or not? That will depend on the textile industry, the government, the raw materials that we can import, and the rules the United States is going to make around what we can import and what we can ship. Because we can import the cotton, we can even import the cotton from USA. But if I have to do a lot of synthetic and fabrics and I have to import it from China, which is my principal import market, but if the US doesn't want us to import anything from China to re-export to America, that option is gone. So then my supply line is not there. So only companies or countries who have their own supply line for synthetics will be able to benefit from this apparel benefit that, tariff benefit they might have. So yes, in a nutshell, without going into too much detail, apparel is the sector that I see massive benefit being available for Pakistan, and home and towel probably is going to be in big trouble, but home is going to have probably equal or maybe some negativity going forward. So moving on. So in my opinion, we can move on to the next slide, please. Can we hear? Who's got the control for the slide? There we are. So this is just I've talked about it before, but this is what categories we sell. If you look at most of the stuff, and the first one is bedding, linen, and all that stuff, which is bed sheets and top of bed. And the last one, which is mattress, support, and everything. These are the two major ones that categorize in the home side, and everything else is in the what I wear and would like to wear or ship within the clothing premises. So all of that combined is the 60 and 30% that I was talking about. And therein lies the opportunity, because China, some will lose some part. And so there are many categories that they are a huge percentage exporter. And those categories, we are doing 2%, 8%, 6%. So we can get part of that business, but then other countries are also going to try and get the part of the business as well. So what you have to look at is my advantage only cost and quality, or do I have a other advantage like a GSP plus in terms of duty? So we do have a fair bit of advantage on the apparel side, not so much on the home side, but we have an unfair advantage on the home side. You'll actually be surprised that the biggest brands that are sold in the United States and UK and Europe, a lot of those brands are actually made in Pakistan. The commodity products are made in India and China. So we have an advantage of quality and brand name recognition of some of these things. My expectation is that the home textile business will also do quite well going forward, despite the challenge of duty. So US as a destination of choice is going to be the one that's going to be difficult. Textile does go to the United States, but as GSP Plus has told us, a lot more goods not only go to Europe, and we are much more comfortable trying to do that business with Europe. As I said, our business is actually geared towards that. Only the apparel side has a much higher percentage going towards Europe. On the home and everything else that I've talked about, which is not apparel, we have a much higher percentage that goes to Europe versus US. So moving on to the next slide, please. I'll give you the broad percentages. So home and bath, 30%, apparel, 55%, and everything else, which includes surgical and everything else, is about 10 to 15%. The 55% is where majority of our benefit lies. And so what we need to start thinking about is, yes, it's very good that we import the US cotton and come, but why is that? Most of the people who don't do textile don't understand that there is something else going on in terms of raw material costing. So Pakistan not only has shortage of cotton, we don't really produce what we need. We also don't produce extra long cotton. We don't produce any organic cotton. We don't really have all the varieties of cotton that we should have had if we had done exactly what India did when most of these international companies came. So what has happened is we have to import cotton from larger, Egypt or USA to compete in the same market in the same price range as India does or Egypt does. So what this will do is, if we can convince the US counterparts that it's better for their farmer to sell the US cotton back to Pakistan and basically make a worldwide system that they want to do, that the US cotton being consumed and re-exported carries a lower duty. So the advantage that India or other countries might have on terms of longer staple or usage of their own, that actually will go away. So we will have a level playing field that we don't. So even though we have a higher cost of raw material, we still compete with India and Turkey and Egypt. So if the cost or the level playing field comes to the same way, everybody has to use US cotton, we will actually do a far better job in terms of pricing than India does or Egypt does. So that's something that nuance, I don't think the negotiating team really got when it was presented to them, but I have a feeling that as it progresses, they will realize that getting US cotton to come in and us becoming the exporter is actually a solution to quite a few things that we have messed up. So we can actually convert our disadvantage into an advantage, just like we did for not having an engineering industry, that we buy the most new machinery and other people still have to protect their local industry, which we don't have. So we tend to make purchases of the best technology much earlier than anybody else. So in the end, I don't really have anything spectacular to add to what has been already been given, but way forward is very simple. We need to become very US focused in terms of what we can buy and re-export to them, specific to them. We need to do it without disturbing the GSP Plus we have with Europe. We don't need to, because most of the raw material that come into Pakistan already carry a zero duty, so it won't really bother us. We need to engage our customers to start to market products that are saying US cotton, benefiting their farmer, rather than talking about organic cotton and all that. If somebody, for example, uses organic cotton and sells a product and moves to a US cotton, they get an advantage large enough that covers the total of 29% duty that will come into a Pakistani product. And since we are the only one with a shortage of cotton, we can actually move much faster onto this US cotton for re-export bandwagon than any other country that I can think of. So that's exactly what we are doing with our customers. A lot of these customers are already increasing their price. So on a nutshell, what tariffs are going to do, most retailers will eventually have to increase the price. And as a result, my assessment is 15% reduction in the home and bath quantities, but 20 to 25% reduction in apparel quantities globally. But individual countries can probably have a much better share of it if we play our cards right. And that's going to happen regardless of whether it happens 90 days from now 2 months from now. The protectionist mindset, which started very slowly some years ago, I think it's now open and it's not going to go back. So the genie is out of the bottle and the bottle has been broken by Mr. Trump. So there is no way we can get it back. So we just need to get acquainted with the new reality and make our strategy accordingly. That's all I have at the moment for this.
Thank you so much, Ahmed Saab, for your insightful discussion. I'd like to thank Ehsan Saab because I think he has to leave. So really, thank you so much for your contribution. I'd quickly request Saqib Shirani Saab, who is an economist here in Pakistan. So over to you, Saqib Saab.
Thank you, Sarwat. Thank you, CFA Society for the invite. Or Ehsan Saab, if you're still around, then thank you for a wonderfully comprehensive and detailed presentation. It really was a pleasure to listen to that. I'll talk about, I'll sort of just zoom out a bit. There's been a lot of granular detailed discussion by Malik Saab and by Emma Jahangir Saab on textiles primarily, and that is well covered. But I think I want to just zoom out a bit and talk about the big picture and some historical context. Jahangir Saab gave us, Emma Jahangir Saab gave us a near history, but I just want to give a slightly longer sort of context of where we are and how we are likely to move from here, or where we are likely to move from here. So next slide, please. So obviously the caveat here, which is that we're talking about President Trump, so there is no certainty or clarity on anything. So what we're discussing is something that's happened, but may not be valid as of tomorrow. But still, there is a certain framework, and that we're going to talk about this next. So there are more questions and answers. Sorry, if you just go back one back, here. So there are more questions and answers. So the first question obviously is this move transactional? Like a lot of people, initial reaction after April 2nd was that this is a brilliant move, a chess move. This is a strategic negotiating masterstroke. But I've maintained from, and some of us have maintained this, and I think Emma Jahangir Saab has also pretty much outlined this, that this is something much more visceral, i.e., this is much more innate and aligned and congruent with internal belief and value systems of those in power in the US today. So next slide. The next point, bullet point. Yeah. So this is the question that the markets are asking. By the way, this moron premium is not my term. This is a term, as you know, the bond markets are very savage. This is a term the bond markets have coined, initially not for President Trump's moves, but for Liz Truss in the UK. And now they're obviously finding it is very convenient to use for President Trump as well. So is it 4D chess or a moron premium? We'll have to wait and see. Next. Now the clues suggest that, just hold it here, please. Yeah, that, just the next one. Yeah. So the clues suggest, and the good thing about, I think, President Trump is, at least the way I've read him, I think so far I've read him rightly, that his stated preference is actually very close to his revealed preference. Right? No matter he might want, he might think he's hiding his cards, or he obviously he plays them at certain times. He surprises us. There are negative surprises vis-a-vis the timing of what he does, the magnitude of what he does. But all along, I think there is a certain mindset at display, which is the next point. Next. Which is that this MAGA mindset and President Trump's mindset is nativist, it's unilateralist, it's perhaps imperialist, according to some commentators. It's anti-multilateralism, so it's towards, unilateralism, anti-globalization, and anti-China. Which is why the title of my presentation is, decoupling, deglobalization, and possibly de-dollarization as well. So, which we'll talk about a bit later. Next. So it's important to understand that President Trump's actions are not restricted to trade, right? So obviously we've seen that now. Something I've been trying to point out, for the past few months. It's related to immigration. It's related to it's related to immigration. With geographic boundaries and borders, spheres of influence, what they're doing to students studying in the US with valid documentation, potentially to investment, that comes into the US, because this is exactly what happened with Japan in the 1980s. So if you want an overview of that, you may want to read my op-ed in Dawn, which was published yesterday in yesterday's edition, Kicking Away the Ladder. And that will give you a lot of historical context of how the US and the West have operated in the past. And it's also related to alliances and travel and the way the US now is going to project power. So only today, there's a viral foreign policy article piece in the Foreign Policy magazine, and it says pretty much bluntly that the US is now going to act like a rogue unilateral power. Right. So I think that's pretty much sums it up. Next. So now, even if I think the bottom line, so there's just a few thoughts on how to view what's happened and it's likely to happen. So in a global context, my view is that even if this is some move, in a 4D chess sort of match which President Trump is playing, and this move is transactional, he wants better deals, etc., etc. The kind of disruption that's been created, it shows, points to the fact that it's very likely that the world is going to go back to where it was on April Fool's Day, April 1st, right? So a global reset is not very likely from here. So something has broken and something has changed. It's the end of an era. Next. So there is a period of disruption, volatility, and uncertainty that has been unleashed, and this can only damage the global economy. Now, my point here is obviously many of you are from the financial markets and are probably logicians, and you'll say, this doesn't make sense that the number of unknowns has shot up. I fully agree with you, but I think you get my point, right? So, we're really operating in the dark here, in completely uncharted territory, at least in terms of the history that we witnessed and we've been brought up in. Now, if you go back historically, then it's important to realize that beggar thy neighbor policies and trade wars have always been a lose-lose proposition, right? Nobody wins a trade war. You might sort of, suck in some benefit through competitive devaluations and tariffs, but ultimately, it's a lose-lose situation. And now a bit of history here. Once again, coming from a foreign policy magazine article that I read just a few days ago, and that said that from 1800 to now, America has faced 6 economic depressions. And the economic historian has described the economic depressions as 6 quarters of economic contraction, at least 6 quarters of consecutive economic contraction. So this is more than a recession, and this is a full-fledged kind of almost like a fairly protracted negative output gap. So that's the economic depression. Now, out of these 6, 5 have been caused by restricting trade by the US. So 5 depressions in the US since 1800 have been caused or self-inflicted, caused by their own actions, by restricting trade, by increasing tariffs like the Smoot-Hawley tariff, and going back even to 1805, 1806, or 1816, I think the first depression, and then from 1873 and then thereabouts to the others, have all been caused by US action on restricting trade. Right? So that's important that's an important bit of history. Next. So, and these trade wars have almost always been followed by currency wars, because obviously one way to react for other countries is to do either reciprocal tariffs or to, initial reaction has traditionally been to employ competitive devaluations, right? And some of these and then have turned really nasty, and then of course they have sort of erupted into shooting wars, actual wars. So what we can say is that there's already a process of geoeconomic fragmentation that was taking place, and it was primarily because the US wanted to decouple, but in an orderly sort of fashion for the US from China. And President Trump has just accelerated that, over a matter of days and weeks. So this geoeconomic fragmentation will accelerate, and we're very likely to get into a Cold War-like situation where we had spheres of influence, one for the US and the West, and one operated by the Soviet Union, right? So this is the same kind of Cold War now with China and to some extent Russia on one side, operating spheres of influence versus the US and the West. And then we should also expect periods of competitive devaluations, quite widespread. And even the US dollar is, of course, this is one of the actually stated goals of what President Trump has done and what his one of his main economic architects for this plan, Dr. Stephen Miran, has explicitly said that we should weaken the dollar, we should devalue the dollar if we can over a period of time. And this will weaken the dollar, but for not the reasons that they think, but for perverse reasons, which is related to capital flowing out of the US. Next. So clearly over a period of time, now mind you, I'm not suggesting this is going to happen overnight or this year or next year, but this is a glacial movement and perhaps a slightly more accelerated movement than a glacial movement, that over a period of time, it's very clear that the US leadership, both in terms of the economy and in terms of politics, is going to decline. It's under threat right now, and it's going to decline steadily over a period of time as new trading blocs and new alliances emerge. There is a shift in global trade and capital flows, so the world adjusts to the US operating, in a certain isolationist manner. There will be large costs of this, move away from multilateralism, especially for the US, because the US has spent the last 75, 77 years in creating a liberal world order, what they called a rules-based order, right? So this they are undoing by their own hands, and they think that it's going to benefit them, but certainly it's going to have very large costs for the US. And ultimately, I think, as I suggested in the previous slide, the US dollar could also lose its exorbitant privilege. It's no longer going to be the world's reserve currency in a few years' time. That process has already started, but it's going to accelerate over the next few years. And this will have implications not just for the US, but obviously for emerging markets and the rest of the world as well. Next. So in a nutshell, the fallout will be much beyond trade, right? And not just for the world, but for Pakistan as well. And I think this has been very aptly and competently summarized by Ehsan Malik Saab and Emma Jahangir Saab as well. But I think the point that I really want to emphasize is that there is, and something which Ehsan Malik Saab touched upon, is that there is a very strong geostrategic element to the new world order that we are entering, right? As I mentioned, it's going to be dominated by spheres of influence, and there'll be tremendous pressure on countries like Pakistan, tremendous pressure from the US, but sort of indirect pressure from China as well. To sort of from the US, the pressure will be obviously to decouple entirely from China and move into the US orbit or the US sphere of influence. Next. Now on trade, so there has been a lot of, and I'm not referring to what Emma Jahangir Saab said or Ehsan Malik Saab said, but what has come out, before today in the papers. So the initial reactions have been based on partial equilibrium analysis. So people have said, so this is the potential loss in the US market based on the differential tariffs that we faced versus some of our near competitors. And I would argue that, of course, that's one element, but we have to widen this to a more general equilibrium analysis, because the entire world's exports, the entire world's economy is going to be affected. Right? There's a very strong likelihood that the global economy will tip into a recession or at least a prolonged downturn because of the adjustments that will need to be done to this trade. And the rest of the world, Pakistan's export market is not just the US, it's the rest of the world as well, EU to a great extent. So what happens in the EU really matters to Pakistan a lot, and then to some of the other markets we may wish to diversify to, and then of course China as well. So we'll have to keep this in mind that there'll be second and third order effects by what has been unleashed by the US. Next. Now, unfortunately, I personally feel, with my sort of limited exposure to this particular area of textiles and apparel, but of course, I've been a banker in the past and, maybe not a banker, but worked in banks. I've worked on the MFA phase out because it had a large bearing on, the bank's portfolios as well back then. So, and of course, a lot of my clients are corporate clients, even like BBC. So I get exposure to a lot of exporters like Jahangir Saab and many others. And so what I hear is, of course, I can talk about the macro fundamentals, and I think I don't need to tell anyone on this forum today that Pakistan's weak. The macro fundamentals are really weak, and they will impact how Pakistan is able to negotiate and how much pressure Pakistan is able to take. That is obvious. But even our industry micro fundamentals are very compromised. And, of course, we know about the energy tariffs, we know about the taxation issues. So I've written, along with Ehsan Malik Saab, I've done a lot of advocacy, even for PBC, on predatory taxation, of how the formal firms in Pakistan are overtaxed, and how we are creating, through this taxation regime, more space for the informal sector in Pakistan and less space for the formal sector to build its economies of scale, to reinvest, and to explore new markets, etc. So that really is there. But I think one thing that I really would like to point out is something which showed up at the time of COVID. And I think Ahmed Jahangir Saab can comment on this later and maybe validate this or dispute this, or at least correct me if I'm wrong. But all of you will remember that Pakistan, because of Bangladesh and India's, the fact that their COVID experience or situation was far worse than Pakistan, a lot of the orders were rerouted to Pakistan. Orders where Pakistan could handle those, at least Pakistan was in a position to export those, etc., etc. And so Pakistan picked up a lot of slack from Bangladesh and India. But 2 years later, and this is what my exporter friends tell me, Ahmed Jahangir Saab can validate this. 2 years later, we were still unable to fulfill all those export orders. Many of those export orders that we had picked, we did not have the capacity. And a lot of potential buyers have spoken to, or my exporters have spoken to, have said, thank you for coming to us, but our experience in 2021 and even early part of 2022 with Pakistan was not good as a reliable supplier. So this really limits our ability to take the slack from some of the higher tariff competitors. And finally, I'd like to say the other thing which is we are really poorly positioned to absorb is when the US and China trade, the trade, I call the US-China trade in the sense that the US wants us to decouple and delink entirely from China. And if we do that and go into the US sphere, we're losing out very badly to one of the, obviously, one of the largest or most dynamic export markets in the world and growth engines of the world. But if you don't do that, we're also obviously going to be under a lot of pressure and perhaps lose out. So we have to think this carefully. Next. So what can we do? What are the so last two slides, this slide and the next. So the mitigation strategies that I can think of, and these are just off the cuff, and in the short to medium term, perhaps we can explore export opportunities to countries that are better positioned vis-a-vis the the tariff, the competitive tariffs. So that's Turkey, Egypt, and Mexico. But I'm not really sure. But I think we can. So Turkey has picked up in the past, stuff from Pakistan to process and then export to the EU market, and perhaps we can expand on that. And I'm sure it's already been worked on. Mexico, I'm not really sure that we've worked on as much, and I'm not sure if we have a complementarity as well, to be honest. So I've not studied this as much. I'm just putting this on the table that these are obviously potential countries that come to mind that where we can. Our exporters can have a look. Now, Malik Saab mentioned this. I've written about this as well a few days ago in another of my Dawn, I think, pieces, which is that we really are doing ourselves a big disservice by maintaining a slightly, call it a stable, and I call it an overvalued exchange rate. Given our fundamentals, this is an overvalued exchange rate. And now you might say in real terms it's not or whatever. That's one way of looking at it. And mind you, the real is very sensitive to the base state. So I'm not really sort of looking at it from the real perspective. Of course, the fact that there's a collapse in inflation in Pakistan has helped our real. But I think it's important to maintain an undervalued exchange rate to the extent that we can, because there's a lot of headroom with our inflation. So even if it's inflationary, we can pick up that slack, by of the undervalued exchange rate in the inflation numbers. So I don't think we should worry too much about inflation right now. Maybe down the road, yes, but I think it's important to give our exporters some more headway or headroom to work with. And of course, we've, Ehsan Malik Saab and Jahangir Saab have spoken about undertaking trade diversion. I think that's an important point. We do not need to expand our import bill. We just need to look at what we're importing from somewhere else that we can also import from the US. Of course, the US is going to be substantially costlier, but perhaps that's one strategy where we can, negotiate with the US to the extent that we can. And final slide, next. And in the medium and long term, I would really emphasize this, that all this cheerleading that we're having, and especially in the markets as well, about, Pakistan's turned the corner and it's done a lot of reforms. No, we've not. Let's be honest. All the reforms that, Ehsan Malik Saab very subtly listed that we need to do. There is rampant smuggling. There's a rampant illicit trade in every sector in Pakistan, which is undercutting the formal sector. There's rampant underinvoicing. Border controls are weak. All these things are going to hurt the formal sector in Pakistan, including the exporters, ultimately. So we need to work on these. The taxation FPR reform is vital, and we've not touched it. We've not touched tax reform the way we should have. So therefore, I think we've not really done real reform other than pension reforms. So I think, before Farooq Sabzari tells me that, हमने बहुत अच्छा काम एक हुकूमत ने काम किए, जब भी concede pension reforms के ऊपर काम किए, और वो भी template पड़ा हुआ था पीछे से, वो implement नहीं हुआ था, तो इन्होंने implement किया, बहुत अच्छी बात है, that's fantastic. But other than that, the entire gamut, state-owned enterprises, privatization, all the product market, factor market reforms, etc., they're all pending. So until we do that, we will continue to be in the weak position, economic position that we are. I would suggest something which is controversial, I suppose, to some extent, to get that pressure off the US and China, of its sphere. I think we should work with India, perhaps, maybe not India, but let's say anybody else, Brazil, the countries that were big in the non-aligned movement in the 70s and 80s. We need to revive that, and we need to champion this with Turkey, Malaysia, Brazil, these countries. And that's one way we can alleviate the pressure, because that will give us wiggle room between the US and China. And this is exactly how India operated. It was actually pretty much under the sphere of influence of the Soviet Union, but because of the NAM fig leaf that they had, they operated in a certain way that gave them wiggle room with both the US and the Soviet Union. But if remaining non-aligned is not an option, I would caution again that to our policymakers that choose wisely. I think that's all I'll say. Thank you so much for listening, and happy to take questions.
Thank you so much, Saqib Saab. Thank you so much, Ahmed Saab, Ehsan Saab, for such insightful session. I think we have really brought a very thought-provoking session. And I think the kind of discussions we had, probably that makes me probably think more clearly if I consider that the points that have been highlighted by Ehsan Saab, Ahmed Saab, and Saqib Saab in the end. I think we are looking, of course, global reset is there, and probably this is going to be a very big change in the global order. And while the last change, as Ahmed Saab also highlighted, was more of a globalization, more of an integration. But now we are moving towards a more, probably a more segmented world where self-interest, where alignment, where opportunities would be prime. And how we really respond to this environment, of course, will decide who would be the new winners. Earlier, we have seen winners coming from Vietnam, capitalize on the opportunity significantly well, integrated itself, positioned itself. Similarly, we have seen some policy response from Bangladesh as well. I think we have such a great opportunity again. And again, it would be easy to capitalize in this opportunity. There are several areas we have to be inward looking and outward looking on both sides, both in terms of our policies, both in terms of all the policy levers. So be it currency, be it our fiscal policies, be it our monetary policies, be it our external account policies, which of course are being implemented. So of course, we are moving towards a whole new environment, would require a lot of probably more comprehensive approach, more interactive approach from the policymakers with the local industry, with the local and international markets as well. And we have to choose our priorities very carefully. I guess you highlighted certain points which required Ahmed Saab's input as well. So Ahmed Saab, would you like to respond to a few of the queries that were highlighted by Saqib? I think they were related to how we respond to the COVID, post-COVID crisis, and how the textile sector had to face certain impediments with that.
So there are two very interesting things, because larger companies generally did a better job than majority of our textile, which was medium size. And the medium sized companies cannot have everything under one place in terms of financing and everything. But what really happened, what he's alluding to, is that the healthcare sector came crashing down to Pakistan because we could still make stuff. And you'll be surprised that we have the finishing capacities, that we can finish product in the healthcare center with CVC or cotton polyester as good as microfiber or 100% polyester. So, patient gowns and orderly, a lot of this healthcare product came to Pakistan in millions and millions of pieces. I got a humongous order as well in one color. We had never seen such a order. The only difficulty is after a couple of years or a year and a half, when all of these things were normalized, you would think that you would continue to do that. But the original product was always in microfiber, or the original product was already in some level of synthetic. We had created a supply chain. We had talked about, putting up factories here, and the minute that happened, this sale tax that was not there, or in board, a few things that, what happens in our bureaucratic circle is that if somebody is making a lot of money, they look at what they're doing and they say, how can we tax this chain? So they practically put up a, stopped part of the chain, taxed part of the chain, and then said, oh, we don't have dollars to give you to import certain aspects that we didn't make in this country. So in that situation, not only that we lost what we had, we could not even increase the size of the capacity those days. So one was healthcare. The other was, you will be surprised, military wear, workwear uses this Velcro. The Velcro, everybody knows what a Velcro is. So colored, dyed Velcro, there were 9 players in Pakistan at that time. You know how many there are today? 1. Because Pakistan Army still uses it. Everybody else has been costed out, 18% sale tax, this, that, the other. They've just shut down their business. They only import all of this from China now. So after COVID, rather than increasing the smaller sector, SME, and support things that you need to have variety of product to make, because cut and sew everybody can do. But what you sew into it needs to be available locally. We have actually regressed from what we used to be before in 2020, 21. So industry is it's actually even narrower band than it used to be between 2015 and 2020. So that's one. The second part, there's a lot of stuff that both the speakers have said that I completely agree with, but I still feel that what nobody can tell you unless you are in the textile industry for a reasonably long time. Nobody wants to talk about it. The medium to larger size companies of Pakistan enjoy a very good reputation in terms of timely delivery, no matter what happens, quality, and a consistency of reasonable price. If you looked at the chart, as Anil said, we are the only country which is closer to the lower part of the product that we can continue to make and not go bankrupt, and we compete with China. Others actually move in a much higher product range. So we do both, but our average is on the lower side. That cannot be taught, earned, or it is just part of how we do business. And that is something that needs to actually be amplified, maybe celebrated, and used a lot more. But then you can't use it when you go to a different country, land a great contract, you come back and say, oh, suddenly the textile industry doesn't get any credit because the banks have changed their mind and nobody can do anything about it. Or XYZ policy happened on some other part of your trade, and so all the cotton is not being sold because the sugarcane people are having a much better time in terms of their crop. So you're no longer a cotton positive country. You actually have a shortage of cotton all the time, and you import, and you don't have a synthetic industry anyways. So what do? You import the raw material. So your pricing locally becomes import substitution rather than export substitution. So you're inherently paying a higher price for everything that you do, and you have a lot less control over what you do. So there are a lot of things that happen outside of the realm of a textile mill or a textile group or an association. Yes, there is a lot of influence that you can do. We have learned about APTMA and all these bigger associations that probably used to be a lot more influential in the past. But because our export has not risen, we've not really done well in terms of competing export to GDP. They've lost their influence. Individuals inside those organizations might have influence, but a lot of times when I look back, it's quite funny. We are taking advice on agriculture from people who have never done agriculture. We are taking advice on import who has hardly ever imported anything. And more so recently, we now take advice on export from people who have never exported anything. So, I mean, this is normal and it's incredible. And when these discussions happen, how they make up the group is incredible. I mean, I don't want to name names, but if you look at the contingent of people who went to advise the Prime Minister's group about tariff negotiations on textile with the United States, 50% of them don't really sell majority of their goods to the United States. They sell to Europe. So they're not even principal sellers to the United States, but they're advising the government. And the guys actually who do it don't even know when the invite went out and when they can have a conversation about it. So it's very interesting. So fundamental things have to change in terms of who you talk to, who is addressed. And then there is obviously conflict between raw material side of our industry and value added. You import everything, then the local industry suffers. If you stop importing, the local industry, whatever they make, doesn't suffer, but you don't improve your variety that you can export to the world. So how do you balance that? Somebody needs to, the regulation part has to become more knowledgeable and maybe more data-driven in terms of their decision, other than getting somebody who is a great bureaucrat once or maybe has as a good orator. A good orator cannot make a great policy about agriculture. So that's really where I want to leave it. But it is a long way that we have to follow. And the kind of predictions that Sagar Saab is saying, or at least what he's putting in it, there's going to be a much tougher going on for Pakistan. I completely agree with that. And we are feeling it on a daily basis when we get a call and we call our Indian or Bangladeshi counterpart that, were you threatened the same way today? It's like, oh, we didn't even get a call. We supply so many varieties. Where are they going to get this variety? So we have a different problem at hand within the same sphere of supplier countries at the moment.
So thank you so much, Ahmed Saab. Thank you again for highlighting several areas where policy input is needed. And of course, as I mentioned earlier, so this looks like an opportunity as well if we are able to position ourselves accordingly. And probably there is more need for working together along with the policymakers from the businesses and from all the areas of policy levers that the rest of the world may also be using that. Since we have already run out of time, my apologies, we would not be able to ask questions, but I would like to I'm really thankful to PSX as well for joining and collaborating for this webinar, and all the audience who have joined here. I'm sure this event, the presentations, the talks that shared by the speakers have really brought some value to you. We have shared a form for your feedback. Kindly share your feedback for that. And I'm really thankful to our speakers. Again, I think Ehsan Saab had to leave, and Saqib also have another engagement. In fact, I know for a fact that Ahmed has to shorten another meeting to join here. So I'm really thankful for all our speakers, and we look forward to more engaging sessions, to a more valuable input for the policymakers as well. Thank you so much.
Thank you.
Thank you.
Thank you.